Welcome to the System Simplified podcast, where we feature top leaders who share stories on how to successfully systemize a business. Now, let's get started with the show.
Hello, Adi Klevit here, the host of the System Simplified podcast, where I feature top founders, entrepreneurs, and thought leaders about systematizing a business. And today's episode is being brought to you by Business Success Consulting Group, where we create, document, and implement processes and procedures so businesses can grow and thrive. And today's guest is Greg Crabtree. Hi, Greg.
Hey, good seeing you. Thanks for having me.
Oh, you're very welcome. I'm so happy that you are here today. We're going to discuss processes. We're going to discuss processes as they pertain to finances, as they pertain to the business, and why they're so important, and give our listeners some good information that they can use right away in their businesses in order to scale, improve, move into a brighter future.
Yeah, absolutely.
But before we get started and I introduce you, I would like to give a big shout out to Chad Gill, who introduced us. And Chad, he himself is a great business coach for Laminin coaching, and he's an expert at scaling and helping businesses work with virtual assistants, virtual personnel. He's great at organizing and scaling and getting the business to the next level. So thank you, Chad, for the introduction. And with that, let's introduce you, Greg, properly.
Yeah.
So you're a speaker, you're an author, you're an entrepreneur, and you're a financial expert. And basically what you do is you work with privately held businesses and you help them in different areas of their finances. And I know that your clients love working with you because you don't use the big, CPA accounting jargon, but you actually help the entrepreneurs understand what you're talking about in terms of finances, understand what they need to do, and you translate it into an entrepreneur-friendly format.
Absolutely. Yeah, that's the reason why the two books that I've written all have the title Simple Numbers. So the first book was Simple Numbers, Straight Talk, Big Profits. I wrote back in 2011. Second book, Simple Numbers 2.0, The Rules for Smart Scaling, came out in 2020. And really, to be quite honest, I mean, I endured learning the profession of accounting. So I told a group yesterday that I'm a recovering accountant. That I really think of myself as an entrepreneur, but I really studied what my clients who were good, gut sensitive, entrepreneurs, what were they looking at? What are the things that they, use to be successful without any help from the accounting profession? And I really I feel like we've hit upon a good process for people to understand data. And really what I want is the data to tell its story. I want the data to talk to you. Traditionally prepared financial information does not speak. It's static. It's like, what does that mean? It raises more questions than gives answers. Data, when presented properly, tells you the story of what's happening and screams about what the solution needs to be. Now, the solution might be difficult. That's an executional problem, from there. But the idea is if you don't structure your data correctly, and there are some things that we've hit upon that I think have been hiding in plain sight for hundreds of years that we now understand differently, and especially the way business works in today's economy, that we've hit upon some really, super sensitive key metrics that, you really focus on and then react to. And the faster that you can cycle through, so you being a process expert, you would understand this, the faster that you cycle through a process and learn from it and then correct it, fix the bottlenecks, and create speed. This is an economy that the winners are the ones who have speed.
Absolutely, I agree.
And that's the key.
I agree. And I interviewed several experts, and that is definitely the common thing is like, how are you going to survive? You have to be fast. You have to be out there. You have to communicate. You have to be on top of it, right?
Yep, absolutely.
I'm curious to hear about, I agree with you 100%. Let's talk about that, the data. Like, what are those key metrics that you have to look at?
Well, So the first thing is to understand that revenue is vanity. And so we are revenue focused, especially the larger the companies get. You even become, even if you know not to be, you just get drawn into the cesspool of being revenue focused. It's not about revenue, it's about margin. And more specifically, first and foremost, gross margin. So in simple numbers, we have a distinct definition of gross margin that says, I want to take revenue minus the directly associated cost. I'm not allocating any cost. I'm not allocating overhead. I'm not putting any labor in it. I'm only using direct materials or subcontractors where I've subcontracted to another entity, not an individual. If I'm subcontracting to an individual to do something, they're labor. I'm not trying to be IRS compliant in the concept of labor. I'm trying to be functionally compliant. And so once I get to revenue minus COGS being gross margin, what we found is when I take businesses across all industries, all different types of things, and get down to gross margin, it's amazing that when I use gross margin as the true economic top line of the business, all the businesses start to look very similar. And what we've also found, and this would be true for most of your manufacturing listeners that are listening, is, there's I wish it was more complex because I could charge more to teach people about it, but it's simple. When you look at, you need your most critical metric is gross margin needs to be $2 for every dollar of labor, whether that's direct labor or management labor, sales labor, doesn't matter what, you can be the CEO or you could be the floor sweeper. $2 of gross margin for every dollar of labor, it hits you in most cases to hit your profit target, that you need to be in a business. And as we teach entrepreneurs, I was teaching a class in Birmingham, Alabama yesterday to a group, and minimum 1.9 to a high of a 2.1. If you're below 1.9, you're not going to be profitable enough. If you're above a 2.1, you're running hot. You're stretching your people to an unsustainable outcome.
Let's give it specific. I love that. I mean, I like it how you actually name it.
Yeah.
Give a specific example, if you would. Let's talk about.
I'll give you an example. I mean, so I've got a manufacturing client that I spent a day with, and there's a lot of other metrics that explain how things are moving. But at the end of the day, we finish the day. This is a sophisticated company. They've got a CFO, they got a controller, they got a bunch of people in their accounting department. They run an ERP system, and it's a well-run business. But at the time when we started working with them, I highlighted the fact that they were underperforming profitability relative to their invested capital of the business, and said, we've got to get you to this number. And we had shown them times of where they can be there, but they make incorrect decisions that takes them off of that pace. And I said, at the end of the day, he says, listen, I'm going to give you one number. I want you to remember this one number, 2. Everybody got that? Everybody can remember the number 2? Good. Now, here's your task. Your salespeople have to sell $2 of gross margin of your product every week for every dollar of payroll that you have on the payroll that week, regardless of what that person does. I don't care if they're working the shop floor, running the manufacturing line, or sitting in the executive suite. That's it.
You basically add the entire labor, like the cost of the labor, and you multiply it by 2, and that's what you need to sell.
Exactly. So it's the same thing. In my first book, I used this concept. People that are familiar with American football, the National Football League, the professional football, they have what's called a salary cap. So all 32 teams pay exactly the same amount of wages, yet there's a handful of teams that have a disproportionate success ratio of making the playoffs, winning the Super Bowl than the others. Well, why is the worst team that hasn't been in the Super Bowl ever, they're paying the same salaries? Why do they not have success? It's because of productivity of labor. And so this is why what you do is so important. It is, and we're in a productivity crisis in the U.S. economy in terms of labor output. But we see signs of companies that have great culture, great leadership, energy, great process, good selection of getting the right people in the right team. That's the reason why some teams win more consistently than others. But you have to have this metric to say, what does success look like? And it's not a complex number. And you got facilities costs. Yeah, you got marketing costs. Yeah, you got some insurance costs. And when we say labor, also our labor number is really clean. It's called gross wages. We do not load it for payroll taxes. We don't load it with any burdens. It is what it is.
So just the labor. So let's take, for example, you're paying somebody $20 an hour. Okay. So you don't add the tax. Well, I mean, the taxes are their taxes are included, not the employer taxes.
Their taxes are withheld from their pay, but the
Correct.
gross wage that goes on their box one of their W-2, or as I said, if you contract with an individual for convenience, and we won't get into the discussion of whether or not the IRS, if they audit it, would they agree? But there's a lot of companies who do direct contracting just because of a person's skill set. I count those people as labor. I mean, they're not a subcontractor in reality.
So basically, let's say you have an admin, let's say an admin person that is you're paying them $20 an hour.
Yeah.
So then you're saying we need to sell 40.
That's right. Yeah, I've got to get $40 of gross margin because of that labor input. Now, that is the simplistic overarching picture. Once I put the team together, especially we're talking about companies that are past $1 million in revenue. These are past the startup stage, and there's no distortions. The owners are taking market-based wages. That's another one of our distortion clearing things that we talk about in the book, that a lot of entrepreneurs that are smaller, it's not as significant once you get bigger. But if you're a $5 million business and the owner takes a $50,000 salary but takes $250,000 in distributions out of your business, they're lying to themselves about the truth of profit. So we're really big on, listen, I don't, when it comes to modeling your business, we fix all of those things in the presentation, because we take your data, put it in our structure so that we can interpret it more clearly, and then use it in a live way to show people, hey, here's all you got to do. So you can't spend another dollar in management labor until you get to this amount of additional gross margin. Now, right. How do I get additional dollar gross margin? It's like we were talking about before the call. It's the 3 Ps. Am I pricing correctly? Well, pricing is an output of effective labor. Whoever is responsible for pricing, do you have the courage? Do you have the insight? Do you have the market knowledge to know how far you can push that price? And we're living in a time where that is an extremely dynamic decision. Right. And to think that you're only changing prices.
In terms of the core, you have to have the courage, because if you have also, I would say to it also, the confidence, right?
That's right. That's right.
But if you have confidence in your people, if you're training them correctly, because it is all related, you're talking about price, productivity, and people. Well, if you have the right people, if they're productive because you train them correctly, right, then you can price it. I mean, you can only price something and charge a lot of money for it, no problem, if you can deliver. If you're productive, you have good people that are productive, they're going to deliver customer service and going to deliver what was promised.
That's right. And so most of the time, as I said, we the 3 Ps is really where the problem is right now when we walk in to see a company that's underperforming. Is, am I pricing correctly? Am I getting the productivity like we talked about? And do I have the right people? Now, our practice is all over the U.S. We're not geographically dependent on where my office is. So our clients are north, south, east, west, all through the U.S. We got clients in Canada. We got clients in Australia. We got a few dotted here or there throughout the rest of the world. So when we aggregate our clients' data in the U.S. We have what we call the 100 company model. So we take 100 of our clients, and we track them on a regular basis so that we get what we see real data, economic statistics that is far more accurate than what the federal government reports. I will tell you, the federal government's economic data, probably not worth the paper it's printed on. Because anybody who's listening to this podcast, I want to ask you a simple question. If you're a privately held business, what does the government know about your company through July of 2023? Nothing. So how do they get their data? They take publicly available data from public companies, which I contend is not a representation of the full economy. We have become a private company dominant economy in the U.S. over the last 20 years. And there's been more companies go private than go public. and with the rise of private equity owned businesses as well, we don't need to go public to get liquidity. We can just go into the private equity market to get liquidity. And so there's not a need to be a public company anymore, to be a multi-million dollar, $1 billion. There are $1 billion companies that are private, because why would I go public and deal with all the cost and just the silly stuff, that goes on with public companies. And so it's created a vacuum of information. And so our model of 100 companies is about 1.3 billion of revenue. So it's a decent sized model. I'm not going to claim that I'm a statistical expert. Hey, I'm a kid that grew up on a chicken farm in Alabama, so take it for what it's worth. At the end of the day, it's been pretty accurate. We've been tracking this data since 2013. I used it first to be a data set that I used it for the second book, for the material that I used there. And we just decided to continue to keep it going. And, it's telling us that, we have challenges right now of where, revenues are flattening to declining on a rolling 12 basis. And that's the number we believe the most, is rolling 12 revenue. And labor costs are still going up.
You mean the last rolling 12 months? Okay.
That's right. The most important number that you need to look at in your business is really rolling 12 data from revenue down to profit. And
so that's an additional, because I was going to ask you what other data you are going to keep. So we have the gross margin you were talking about, and then we also keep the rolling 12 months of income.
So you look at, the big numbers are this. First, I got to get to gross margin in that clean way with no allocations and no labor included. That's our definition of gross margin. Then I'm going to apply the first test against it of gross margin divided by all labor. That's no loads, no payroll taxes, just labor. And am I in that 1.9 to 2.1 range? And if you are, I will tell you then the third data point that's the most critical of health is look at your EBITDA, or net operating income, as a percentage of gross margin, not revenue. The profit to a percentage of revenue is just a canard. It is just not worth it in it. Right. It's not telling you what you need to know. So then, especially because you're dealing with companies that have COGS and manufacturers or distributors, and so it's that gross margin number is the more important number.
Absolutely. I mean, we personally, my company, for instance, we deal with service industry, within manufacturing, with construction. So we have different, just like you, all companies.
And see, you're a great example of this. So you could, and so if you look at the Simple Numbers 2.0 book, there's an example in there. We call it in business. There's only three things that happen in business. You either make stuff, you sell stuff, or you do stuff. So you're either a manufacturer, you're a sales company, or you're a services business.
Service provider, absolutely.
Once you apply that filtering technique to get to gross margin, you actually see commonalities of data using gross margin as the top line that you measure everything to. And there's a few outliers. There's always going to be some, but you're talking about the vast. 90% of the marketplace works off of these simple measures once you do that filtering technique.
Absolutely. So Greg, the third one you were talking about, the EBITDA as a percentage of the net operating income.
You take EBITDA as percentage of gross margin.
Oh, percentage. Sorry. Yeah, that's right. Percentage of the gross
not
margin.
Revenue. And now
no revenue. What are the indicators? What are the numbers there? What's the what are you looking at there in terms of?
So what I'm looking at there, what has become the overarching guideline of profit of my EBITDA to gross margin. 10% is the minimum. 15%. 10% is the absolute minimum, but that's not healthy. So you really want your minimum to be 15, your target to be 20, and stretch is about 25. Now, some people can be over 25. That's great. I'm just going to warn you, the market's coming after you. Once you get to that high profit number, the marketplace, enjoy it while you got it and appreciate it, but it won't last forever. But what we see is a lot of companies that operate in that kind of that 10% is the warning sign that of profit to gross margin, that because you're turning over a lot of cash at the top, and you generally don't get paid before you have to incur cost, you got a lot of turnover cost, and so you're just not generating enough profit to be cash flow positive. And so one of the things that we try to teach our clients to do is really be cash flow positive with our profit and our terms between customers and or vendors, and use the whole ecosystem as best you can. Now, some businesses, there's just harsh parameters that keeps you from having that happen. But in the second book, we call it CPR. So the cash power ratio is where, if I take all of those turnover costs, what a lot of people would call working capital, we take working capital and say, listen, take the classic definition of working capital and exclude cash and exclude debt. Once I take those two out of it, we come to a term we define as trade capital. That is the stuff that turns over. So AR plus inventory plus work in progress minus accounts payable minus accrued expenses minus deferred revenue. What is the net of those numbers? And what we found is this amazing relationship of cash flow positivity between, if I can get trade capital as a percentage of trailing 12 revenue to be lower than my rate of profit, every new dollar of revenue is cash flow positive. When trade capital as a percent of revenue is above my profit number, I burn cash to grow. Now, what I've always, I really fancy myself as, I'm really a behavioral economist at heart. I mean, if I was going to go back to college and actually get a useful degree, I'd get a degree in behavioral economics, because what I strive for is, what is the piece of data that I can create that gets you to do what's in your best interest?
Right.
Because we don't naturally do.
Greg, just this is really what the gist of it is actually getting the data that entrepreneurs, it's easy to understand, and they actually work off of it. Because I don't think, I taught that a class called Reading Financial Reports for a Non-Financial Owner. And the reason why people don't read it is what you said at the beginning, just stagnant. It's not, doesn't give them any information. They read it and they see it, but they can't act upon it. So your point in terms of having data that you can act and do something, that is what is missing. And that is so important.
Well, and what's interesting, I mean, for years, I would, go over days sales outstanding, days in inventory, days in AP, and all those kind of numbers with clients. And you would look at it and, fixing those numbers that are on the balance sheet, it's kind of like weeding a garden. I mean, you'll put some effort to it, but you won't keep it there. It'll grow back to the dysfunction that it had. And so I just kept noodling on, okay, what can I show them that gets them fired up to keep it in line? And when I came upon this trade capital concept as a percent of revenue compared to profit, I'm just blown away. I finally have clients who pay attention to the balance sheet, of all things. And it's not so much singular, they're trade-off decisions. If I can't move AR, okay, can I get more trade credit from my vendors? If I can't move inventory, can I get my vendors to give me more coverage, or can I get inventory down? And as you see trade capital move, especially now that the interest rate environment has moved up, a lot of my clients do not have amounts drawn on lines of credit. They actually live off of their own cash, which is what we prefer. But a few that do, they really start getting serious about that balance sheet as interest rates have gone up. And they say, listen, you've gone from a 5% trade capital to revenue to 8%. And, that differential that means you got $1 million more on your line of credit, that if you can get that 8 back down to a 5, you would pay interest on than $1 million less principal on average across the year. I'm like, oh yeah, okay, let's and all of a sudden now they're motivated. They see the significance of it, and it's huge.
It's huge. I mean, it's huge to have all that understanding. I mean, I think really what I learned from you today is that you really have to understand your numbers. That's why your book, Simple Numbers, is so important. I definitely recommend our listeners to go to Amazon, right? You can get it on Amazon.
Yep.
Right
Both
now,
are available. And it's on audio. You can hear me read it.
Okay, good. But I think you do have to have a piece of paper and write things down and sketch things so you don't get confused about it, because there are definitely a lot of terminology, but it's simple terminology. So I would definitely recommend doing that. And I think the moral of the story is that you have to keep numbers, but you have to keep meaningful numbers. They don't have to be complicated, but those are numbers that you can act upon. So I think any data that you're keeping, if you have a scorecard, you have to ask yourself, why am I keeping this number? How am I going to act upon it when I have the data and I can compare it to other numbers, right? I mean, you have to have that action built in it.
Yeah. Yeah. One of the things that you'll see if you look at our, especially the second book, we go, you've got the overall labor efficiency concept that I talked about. When you really want to refine your game, we have what's called direct labor efficiency as well as management labor efficiency. And I will tell you that undoubtedly, if you want to improve the profitability of your business, it is about getting better at management labor efficiency. So we have a technique to actually measure the efficiency of management, and it strikes fear in the hearts of management teams.
How do you do that?
So it's really quite simple. If you take, so you got gross margin, as we said, gross margin minus direct labor is a term we call contribution margin. So it's roughly equivalent. It's pretty close to what most people call gross profit, but we call it contribution margin. So that's the numerator. That's the number we hold management labor accountable to. And so the idea is we just look at management labor efficiency ratio on a rolling basis and say, is it getting better? Is it getting worse? And generally, I will tell you that direct labor efficiency is all across the board relative to the type of business that you do. So there's some high labor efficiency businesses, low labor efficiency businesses. Management labor, though, it's generally between a 3.5 and a 4.5. So I'm generally needing somewhere, just use 4. I generally need $4 of contribution margin for every dollar of management labor. And the idea is because the way we track it, as you see, let's say I make an investment I add people to my management team. Well, great. Now we can now backwardly calculate. Here's now the target of contribution margin, which then backwardly calculates into the target for gross margin and backwardly calculates into revenue. Here's the revenue that you got to add to justify that add to the management team. And we've done this calculation 1,000 plus times. It's a low of a 6 to a high of a 10. The average is 8 as a multiplier of revenue to management labor. And that if I add an incremental dollar to management labor in raises, bonuses, or bodies, I got to get about an 8-to-1 ratio to get back to my operating parameters. And absolutely. So we believe in the ideas of multipliers. And so the idea is, what are the levers in the business that get you, it's really key to kind of what you do, is that's where you're getting that massive lift in productivity, because we've got to drive to this point, and we have to have the discipline to say there will be no more dollars added to this bucket until that happens. And the error that we see constantly is people try to squeeze their direct labor, the very engine that it takes to do the things that you need. It ain't about them. Pay them what you need to get them there. It is about the margin activity that those people produce that I've got to hold constant to the management labor piece.
That's so true. That's so true. It's not about cutting labor costs. I mean, obviously you have to be efficient. You don't want to be overstaffed if you don't need to. But it's about driving the revenue, selling more, being out there, promoting, marketing, etc. I mean, I agree with you 100%. Greg, we are coming to the end of this podcast, but you gave us so much information. And what I love is that you provide actual measurable multipliers that a business can create a dashboard and operate by it. Yeah. I am convinced that if any business owner contacts you and you consult them on how to build those multipliers, they're going to have something to manage by and really have a clear picture of how their business can be successful. And you can overcome any economy if you really know what you're doing. And if you are, again, you have the productivity, you have the people, and you have the right pricing.
Well, and this is a very unique time. I mean, we're in a marketplace that is actually relatively flat in terms of its ability to grow because we have kind of a stuck labor market. However, we are seeing the reindustrializing of the U.S. economy. And so my manufacturing clients are actually some of the fastest growing, that we have as those opportunities move back on shore, in all of those things. And so, whereas as a general economy, we're saying, hey, it's a street fight. You got to, you can grow, but you got to go take it away from somebody else because the overall market isn't expanding. That's not true in manufacturing right now. And manufacturing is one of the expanding areas. And I mean, my manufacturing clients, I got one guy in South Georgia. I mean, he's doubled in size in the last 2 years. You got others, that are growing, 15 and 20%, but the ones that are growing 15 and 20% are growing because their competitors are failing and they're succeeding. Right. But it's a challenge every day, and they've got to do everything you're talking about to stay on top of it, to stay in the game.
Right. Well, when the game is challenged, it's challenging. When you gave the example of the football, okay, you have to have a really good coach, right? Mm-hmm. You have to have somebody that can guide you and get you to where you need to be, so you are better than everybody else. So
that's right.
You go. Okay, so I encourage our listeners to contact you, and I'm going to include in the show notes your information, how to get a hold of you, and definitely go to and right now go to Amazon, Audible, get Simple Numbers, the 2 books. And Greg, thank you so much for being a guest on this podcast.
Thank you so much. I appreciate it. Anytime.
Thanks for listening to the System Simplified podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.